So welcome to the LSEG Academy, and this morning we will be looking at a review of the European fund flow markets. My name is Claire Owens and I am based in London, and I'm joined today by my colleague Dowie John, who is Head of Research for LIPA in Europe. Just a small bit of housekeeping before we start. We do have a few people on the line today, so if you could keep yourselves on mute for the duration of the presentation. We will also be allowing time for questions and answers at the end of the session. If you do think of anything partway through the session, feel free to submit any questions via the chat. I'll be monitoring that throughout the session, and the slides and the presentation will also be circulated afterwards. So without further ado, I will hand across to Dowie to get us started. Dowie.
Good morning, everyone. Can you hear me?
Yes, we can hear you.
Fantastic. Okay, great stuff. So as per normal, this breaks down into three sections. There is a brief macro overview. Then I'll be looking at how this has impacted on, basically set the stage. Then I'll be looking at how that's impacted the broad market, but fund flows for Europe. And then we'll take a dive into the sustainable fund market in Europe, i.e. SFDR. So let's kick off. I'll get the slides to work. Disclaimers, important bit. And while the music plays, so let's see what exactly I mean by that. Macro outlook, brief overview, risk declining, base rate pressure is down, yield curve steepen, and global equity values, we'll get to that. It's always good to have younger participants on the call, but if you could mute them, please, that would be marvelous. And we will look at the impact of this guy. Those of you who are a little long in the tooth will remember this quote from just before the financial crisis, and we'll have a look at how maybe that may have some bearing for today. Not that I want to send hairs racing. So, first of all, good news. When I first used this slide a couple of quarters ago, we were right on that far right-hand spike with the reaction to the April tariffs, and that volatility has since significantly declined. Markets are somewhat less panicky. And if we look, that's equity markets. If we look at fixed income markets, we can see the same thing is happening here. The market didn't exactly take massive fright in fixed income terms, as indicated by high yield spreads. But there's been a steady decline since the inflationary spike in 2022. So all good news in markets. Central bank policy rates, we continue to see a divergence between the UK and the US on the one hand and other G7 economies, higher rates in the former, lower in the latter. And an increase in the further out and the yield curve with rates going up. I mean, there's a lot of, I sit in the UK. There's a lot of talk in the UK market about the egregious state of public finances and debt financing costs. As you can see from this, it's not simply a UK problem, although the UK suffers from it worse. Everybody's financing costs expressed through, or everybody in terms of governments, are increasing as curves steepen. So you see on the one hand, as base rates come down, there's pressure downwards on the short end of the yield curve. The longer end is being pushed upwards, so we are seeing a steepening of the yield curve, which feeds through into wider financial markets. So, of course, go back 1 year, 2 years ago, we were all worried with a negatively sloping yield curve as a harbinger for recession, as it so often is. Now, as the curve is positively steepened, we're all worried about the state of public finances. Everybody's got to worry about something, yeah? And that's the illustration of that point there. One other thing to worry about, I'm not necessarily sure how worried you should be about that, is here I ran the MSCI ACWI, probably the best known global equity index against GDP growth from 1995 up until today. And you can see, particularly as evidenced by April 2000 to March 2003, and of course October 2007, and the correction below GDP growth levels to when the market rebounded in March 2009. What goes up must come down. So we saw a correction again, October 21 on the right hand side of the graph to October 22, where the market rebounded, and there's a significant divergence of equity valuations and growth in the real economy there. And of course, this is where we are now. So one would assume that at some point it's going to come down. It tends not to come down gently. This is the largest divergence between the two metrics that we've seen in 30 years. Can it go on longer? Of course it can. So this brings me back to the quote I opened up with from Chuck Prince of Citi before the financial crisis: just so long as the music plays, you have to keep dancing. So let's see how investors have been dancing in Europe over the year to date. Main points: positive flows, bonds most popular, but on a more granular classification level, money market dollar funds have been most popular, and second most of money market euro counterparts. Outflows, equity UK continues to suffer. That's domestic UK investors by and large. So into the detail: assets under management in European mutual funds and ETFs. How is it split? No great surprises here and no massive changes. Equity holds the majority, 44%, followed by bonds, and then mixed assets. Money market funds, despite the strong sales, are only 13%. Everything else tags along. Other, I like, it's a kind of rounding error. It doesn't even make it to 0%, but never mind. Active versus passive. Active funds are still the majority. Passive funds less than 42%. However, if you strip money market funds out of that, which are money market, and look at simply long-term assets, bonds, equities, mixed assets, and so on and so forth, it skews further towards passive funds, as you'd expect. Money market funds are still essentially an active asset class. Quick look at performance trends. What have we seen over the past? This is 8 quarters. A lot of volatility in terms of what's delivered performance. Strangely, over the last quarter, US small and mid caps have been very much an unloved and underperforming asset class. And if you go back to, say, Q1 this year, the far light blue bar on each of the clusters, you see strong underperformance there, but now quite significant rebound. And of course, China has delivered strongly over the past quarter, and a supposedly uninvestable section of the market. How does that pan out over the year to date. Again, strong performance from China. Hello, is that somebody coming in? No. Okay. Secondly, we've seen strong performance from Europe year to date. That's been patchy. And also, surprisingly, UK large caps, the FTSE 100, third best performing schedule on that chart. How is this reflected in flows then? Rhetorical question. Could you put yourself on mute, please? It's a little distracting. Thank you very much. At the asset class level, what are we seeing? This is year-to-date figures. Bonds are the strongest performing asset class in terms of flows, followed by money markets, then equity. And you can see a rotation from mutual funds into ETFs within the equity market. Certainly on a single instrument basis, equity ETFs have got the majority of assets on a year-to-date basis. Everything else follows on a much lower level. Mixed assets, alternatives done reasonably well relative to the asset class, but still a long way behind the three big ones, bond, money market, and equity. Okay. In terms of flow by vehicles, again, long-term ETFs have garnered the majority of the market. Actively managed funds, if you take the bar together, is still taking majority of assets, but a very large chunk of that is money market funds. ETFs really don't take very much of that. And as you can see, that middle bar, we're clearly seeing something of a rotation from within the passive market of investors transferring from index tracking mutual funds into their ETF equivalents. On a more granular level, looking at year-to-date classifications, as I said before, you can see that the top classification is money market US dollar funds, followed by money market euro funds. Now, the interesting thing about this, I got asked on the UK call yesterday, is how are investors using these? Are they squirreling away assets like to use as dry powder for relevant assets? So are they looking to invest in US equities, US bonds, whatever, and just sitting on the sidelines in the appropriate fund at the moment? Are they taking advantage of a higher rate on offer in these cash vehicles, or is it something else? Well, let's deal with something else first. Something else is that corporates use a lot of money market. Frequently, sorry, let's string together some kind of coherent sentence out of this. Corporations use money market funds to pay out from corporate actions. So, for instance, at dividend payments, prior to that, they'll often park cash in a money market fund, or to find that, to store cash in for a merger or acquisition, something after that fashion. That, I think, within the European market is less likely to be the case for US dollar funds, apart from possibly in the UK market, but we're not seeing that in the UK market, obviously because a lot of UK companies pay their dividends in dollars. FTSE 100 companies pay this. So what this is more likely to be is either investors moving from domestic cash into US cash to take advantage of the higher rates. But there's a but with that. Obviously, the dollar's weakening, so that's probably offsetting. So my feeling here is what's most likely is that you're seeing a parking of cash on the sidelines, ready to find an opportune time to buy US long-term assets. But that is simply a guess. Also, what you can see further down the chart here, just draw your attention to the bond classifications that are selling pretty well. Bond global short term, bond euro short term. I think what may be happening here is that as short term rates come down, the short end of the curve gets pulled down, as I referred to earlier in the presentation. You're not getting such good rates on cash, and therefore investors may be being tempted into short-term bonds, low risk, higher yield than they would be getting on cash at the moment. Money market, going right to the far right side of the chart, money market, Turkish lira is the second to worst one. There were a lot of inflows into Turkish lira money market funds at the tail end of last year. There were certain attractive trades within the Turkish market. That came off, and we saw a huge outflow from these funds, particularly in Q1 of the year, and that's still acting as a feeding through, although in Q3 seen very little activity there. That's kind of been and gone. Equity UK is consistently unpopular. Those are domestic outflows by and large. If you X out the UK from there, there's not much happening. But within equities, on the positive side, equity global has remained a very positive trade. If we'd have looked at Q2 trends year to date, the graph looked at rather different. Equity US was much further up there. We saw big outflows at the start of Q3 in July from equity US funds, and that's pushed them out of the top 10 table. The flows have rather reversed over August and September. They've turned positive again for US equities, but not quite enough to counterbalance the big redemptions that we saw in July. Possibly that'll feed back through in Q4. Anybody's guess at the moment with markets this volatile. Top 10 fund providers, BlackRock doing exceptionally well, of course, on equity, particularly equity ETF trades, although seeing outflows from its mutual fund business. And then other major players. But if anybody's got any I'm not going to dwell on this, but if anybody's got any specific questions here, feel free to chip in. That's the conclusion to the general European fund market overview. If anybody's got any questions at this point, anyway, as I said, just stick your hands up, put something in the chat. Otherwise, I'll move on to the sustainable market. I can't see the chat, so Claire, let me know if there is anything in there.
Nothing so far.
Okay. Everybody's blissfully happy with the answers they've got so far then. Sustainable key points. AUM, still got rising assets, heavy redemptions in some asset classes, particularly equity. And again, as we saw in the conventional fund market, money market, US dollar funds have done particularly well here, with equity US seeing significant outflows. And again, that's kind of what pushed this classification out of the top 10 within the conventional fund market, although it's not just sustainable funds. We will see that in more detail a little further on. Article 8, by far the largest sustainable fund class, lower hurdle rate than Article 9 funds, SFDR. That's heading upwards on trend. We saw the tail end of last year, something of a depression there into Q1. Seems to have recovered from that, mainly in the equity space. Article 9 funds, again, we saw a similar but worse depression in assets. Again, this is, as you can see, this is far more than Article 8. This is not. This is an equity play. And in terms of demonstration of impact, you can see why that would be the case. It's an easier market to make that case for. It suffered strongly at the start of the year, and things seem to have rather stabilized since then. But there's a caveat there in terms of, I think this is more market growth rather than flows, as we'll see now. Article 8 flows over 8 quarters. I think one of the, or two of the things to remark on here, we've seen a recovery of mixed asset flows over this period. As you can see, that yellow, gold, call it what you will, bar, section of the bar was negative all the way through to Q4 and has since recovered, and positive flows are increasing there. It's still fairly small, but there's a clear trend there. Bond flows are fairly stable, excluding Q4 23. That seems to be a reasonably robust section of the market. As a money market flows, we're still seeing a degree of volatility in the equity space. Q2 was negative. Q1 was basically a sliver, fairly neutral, and we're seeing Q3. There's been something of a recovery there. That's much less the case, as you can see, with equity flows in the much smaller. It's about 5% of the assets of Article 8 funds. I did speculate in Q2 as to whether we were seeing a stabilization or even a recovery of Article 9 assets, mainly in the equity space. That's clearly not been the case, as outflows have accelerated in Q3. So, the only real good news story for Article 9 flows is for the past quarter certainly has been in the bond space. Year-to-date flows, summing them both by asset class. Again, this is quite reflective of what we've seen in the market overall. Strong bond flows, strong money market flows. Both of those, particularly with money market, sustainable funds or Article 8 funds, take the majority of that market. You flip over, on the other hand, to equities, where you've seen strong equity flows. In fact, conventional equities have done very well. Sustainable equity funds, Article 8, Article 9, particularly Article 9 flows have been significantly in the red on a year-to-date basis. On a more granular level, the level of Lipper global classifications, again, a similar story to what we've seen in the broad market. Money market USD, followed by money market Euro. I mean, the money market dollar market is entirely sustainable. Why that should be, I don't have a clear idea. Target maturity bond comes next. And it's becoming clear that this is quite a risk-off market, because target maturity are often used as cash-like funds. And again, bond Euro short-term, bond global short-term, as we saw before, sustainable assets taking the majority of those. The only significant equity play we're seeing in the sustainable market that's taking money is equity Europe, where it's taken about half of that market. And a little further down, right at the right-hand side of the market, right-hand side of the graph, sustainable equity global income funds have done quite well, although not global funds per se. You see, in outflows. And despite the relatively strong performance of conventional equity US funds over the year to date, we've seen a rotation from sustainable funds into Article 8, Article 9, more accurately, how sustainable Article 8 is a moot point, into conventional funds, Also a rotation on the next one's down, bond USD corporates from sustainable through to conventional. And jumping down to equity theme, alternative energy. That's still very much an unloved classification, with a large amount of money coming off that from Article 9 funds. If you go back to just before we saw the inflationary spike around 2001 into 2002, there was a surge in equity theme alternative energy stocks, mainly through quite focused small and mid cap ETF passive index plays that had something of a crunch as a result of both large inflows and then meeting an inflationary spike. These are quite bond-like, have quite bond-like characteristics because they're quite debt-laden, so the market's not really recovered from there yet. So we're still seeing that section of the market suffer. And from there, any questions?
I don't see any on the chat at the moment, but if anybody would like to take themselves off mute and ask a question, now is the time to do that. Or you can submit any via the chat. Thanks for that, Derry. It was very interesting. I guess in terms of the strong inflows into bonds and money markets, with the markets being how they are, do you foresee that continuing for the rest of the year and maybe into next year?
I think we're going to see a lot of volatility in this because it's mainly because of geopolitical uncertainty. So, and it's not always clear what the trigger is. So, for instance, if you look at the way the market reacted in April as a result of tariffs, that's entirely intelligible. If you look at the outflows that we saw in equities at the start of Q3, that's much less easy to decipher. And when you dig into it, it's not a generalized rush for the exits. What you see is a small number of very large funds, money being taken off the table. So it seems apparent that what's happening there is either an individual or more likely a focused cohort of very large institutional investors making some significant decisions about where to put their cash. And that can really move the market. You know, what one or two investment committees decide on a large pension fund, for instance. We don't know where that cash has come from, but it would indicate that that's the situation. And we're seeing quite a lot of this in the market at the moment, if you like. Not so much the tail wagging the dog, but it's quite focused decisions are making large market impacts. Plus, again, who knows? You know, I would imagine the market's quite ebullient at the moment with the meeting between Trump and Xi, and the impact that'll have on tariffs. That can reverse at any moment, as we know, but may not.
Yeah. I think it was interesting yesterday. Obviously, we saw on the UK webinar, for those of you who were there for that, we saw massive redemptions in equities as well. But there was, I think you mentioned, Dari, there was a slight difference in how Europe is reacting to how UK is necessarily reacting, so with the UK potentially being more risk averse.
Definitely, yes. I mean, this presentation today, this is Europe as a whole. It includes the UK. If you look at just the UK data, what's unlike Europe, so you've got money market funds, then bonds. Actually, money market funds is what are dominating flows. Pretty much everything else is in redemption mode, particularly equities. So if you were to exclude the UK, which is, of course, a very large market, from this data, you would see a market that was much more much more of a risk-on type market. So we're seeing something of a barbell distinction between continental Europe, which is much more equity friendly at the moment, and the UK, which is has consistently throughout the year been dumping risk assets. And again, why that should be particularly, I don't have a clear idea, although very slight caveat to this, the UK in terms of total net assets tends to be more of, it has historically been a more equity laden market. So that could be a correction feeding through, but why now? Don't know.
Yeah. Okay. Just got a question on the chat. So how do you interpret the divergence between high US equity valuations and the outflows from US equity funds over the past months?
Good question. Okay, I think one of the impacts has been, I mean, again, this hasn't been consistent. There was one specific month, July, that really impacted on US equity flows. US flows, apart from that, haven't been that negative. And if we go back to here, for instance, if you look at equity US flows, flows into conventional funds have been reasonably robust. However, they've not been as strong as anywhere near as strong as they were in 2024, for instance. Now, there are likely two interlinked reasons for that. One is, or three actually, high valuations. High valuations are great because your stock value is going up, but for a lot of investors, that might be a bit something that's quite worrying, considering how focused on the Mag 7 this is, or has been in general. Obviously, small and mid caps did very well in Q3, but it hasn't been the case consistently. Geopolitical uncertainty, very much focused around the US. And finally, if you are a euro or sterling investor with, or not actually, more specifically, a non-dollar investor, the weakening dollar is having a negative effect on your returns as well, which is why we see, despite in dollar returns, the S&P 500 has done very, very well. In local currency terms, for European investors, both the UK and Europe ex-UK are well ahead of the US market year to date. So three potential factors explaining that.
Yeah. Okay, great. Thank you. Yep, that answered the question. I don't see any further questions on the chat, but if anybody would like to take themselves off mute and ask a further question, for Darry, we still have a little bit of time.
Or you can have the rest of your morning back.
I would, yeah.
Win-win situation.
I'll take the silence as a no, which is fine. So Darry, just for reference for the people that we have on the call, all this data was taken from Lipper for Investment Management. Is that correct?
Yes. Yes, yeah. And is most of it is in our monthly market reports, which you can find on the Lipper Alpha Insight website.
Yeah. So yeah, that's a good point. So for those of you who aren't aware, there is a separate Lipper research website where Darry and his colleagues are constantly providing market commentaries, and these reports will also be listed there as well. So I don't think we have any more questions. So I think I can give you 10 minutes of your morning back and we can close the session. If you do have any questions or anything occurs to you after the session, feel free to reach out to us directly and we'll do our best to answer your questions. And I thank you all for your time and wish you a pleasant day.
Thank you very much, everyone. Thanks a lot, Claire. Cheers.
Thank you.